For me, a V-shaped recovery is pretty tough to trade and definitely not my style.
This recent base is definitely a lot wider, sloppier, and looser. And that's definitely a signal that more institutions are distributing.
They call those Hotel California trades where you can check out
Yeah.
anytime you like, but you can never leave. Hey everyone, and welcome back to another episode of Trading Takes. I'm here with my co-host Judah, and we have two special guests on today. We have Ted Zhang and Connor Bates. Gentlemen, welcome to the show.
Thank you. Happy to be here.
Yeah, thanks for having us. Excited to be on.
Yeah, absolutely. So both of you are both asset managers at Revere Asset Management. So we wanted to have you on to get your perspective on the markets and just to share your journey. So for those of us who might not be super familiar with your progression and your career so far, could you each give, a quick intro of who you are and how you got involved with trading and to where you are right now in your career?
Yeah, definitely. I'll start. So basically started in 2020. So going on 5 years now. I was a freshman in college and we just got sent home because of COVID. So was at home, didn't really have anything else to do. And I think a lot of people ended up getting into the market that year. So as the market bottomed out, I started trading. And like anyone that starts from the beginning, you kind of try everything, that comes around. So found an edge trading SPACs, special purpose acquisition companies. I'm sure you guys are familiar. And then just kind of progressed. I was pretty busy. I went to Stetson University in Florida and I played Division I soccer. So it was challenging balancing trading and playing soccer and school. But since 2020, all throughout college, I was trading pretty much every day, watching the markets and just kind of, after trial and error, kind of started to find what worked for me. And then that led me to, right when I graduated 2023, started as a portfolio manager at Revere Asset Management. And that's kind of where I'm at today. It's that's a brief background on me.
Excellent.
Yeah, so I'm going to take it back a little further. Connor and I met first playing soccer at a boarding school freshman year. It was a development academy in Minnesota. So that's where we first met. I'm from Northern Virginia, outside of Washington, D.C. So I decided to go back home just for various reasons. And then, like Connor said, when COVID hit, we're both freshmen in college. Somehow just started talking again about the markets. Haven't talked in 4 years since our experiences at boarding school. Again, we have a pretty similar experience landing this job. So started in SPACs as well. We noticed an edge with the timing of the definitive agreement between a company and the SPAC, and then the timeline through into the merger. And we didn't really know technical analysis back then. We just kind of purely timed each SPAC based off those various catalysts. Did well in there, but that eventually ended in February 2021. And like all new traders who don't have risk management, position sizing, cutting losses, and just a general understanding of the markets, definitely gave back a decent amount. Through that, discovered people like William O'Neill, the Market Wizard series, Stan Weinstein, Mark Minervini, Zanger, and those are, Connor will probably talk about this later, some of our bigger mentors in the space. Stanley Druckenmiller is another person, Jesse Livermore. So that's where we really started getting our footing in trading in the markets, learning risk management, position sizing, situational awareness, analyzing the indexes for accumulation days, distribution days, and really honing in on our system and strategy. And in college, Connor, he was gonna do another year playing Division I soccer and do his MBA. I am a non-traditional path in finance. I was a biology major on a pre-dental track. I finished that, did really well in that, and got my acceptances in the dental school. But just throughout college, kept really spending a lot of my free time. I would tell my friends sometimes on a Friday that I'm not going to go out and study charts in the markets. They more or less understood that, but those are some of the sacrifices I made with like that course load in biology and pre-dentistry. And just one summer, Connor, like we do not want to continue on like our current paths. So we DM'd like 25 to 30 portfolio managers on Twitter, and we've both built a decent following on Twitter as well. So very non-traditional path into the space. Really got lucky, both landing a job at the same firm and just having our friendship progress through that. And we're here today talking to you guys.
So similar to Ted, he got accepted into Columbia Dental, and my original thought was that I was going to try to play professional soccer. I didn't go to a target school to land a job at Goldman Sachs or whatnot, but it was kind of just like the passion for the markets and knowing like this, I like this more than anything else that I'm doing. And then it was more so trying to figure out where's a career that we can trade and do this like for a living. And we got pretty lucky how we both landed at the same firm. It's ironic that it happened, but it did.
Yeah, in dental school, who needs pulling teeth that way when you can pull teeth as a SPAC trader?
Jeez. Yeah.
Sure, you guys have both had some interesting experiences with that. But before we get into some of the outline, you guys are both athletes, and I want to just draw some comparisons of what do you think about being a highly competitive athlete versus a highly competitive trader? Do you see a lot of similarities, or the training that goes into that? How would you describe that?
I'll let Connor go first because he went further in soccer.
Yeah, there's so many parallels. I could go on and on, but one main one is like, if you have a game on Friday, soccer, and you have practice Thursday, if you're not giving your full effort, if you're not treating it like the game, you're not going to perform. So stock-wise is like, if you're not doing your work once the market closes, if you're not scanning, reviewing charts, making a plan, you're going to be unprepared for when the market opens. And just like soccer, you're going to be unprepared when the game starts. So just work ethic is obviously a big thing. And then another thing is just how ultra competitive trading is. All sports are super competitive, and I don't think trading's any different. At the end of the day, you're battling against a bunch of other people, and you want to win. So that competitive nature definitely translated into trading. And I think that's something that attracted me a lot. Is some other careers could be just nonchalant, but trading's just always a battle every day. And that's how I was my whole life playing sports.
Yeah, so I also played soccer for a while, 15 years, didn't decide to play in college. And I definitely agree with everything Connor said, the discipline, the work ethic, persistence. But I also want to just like make an analogy. Cutting losses in trading is almost like you mess up in a play in soccer. Well, we played soccer. You mess up on one play, you have to forget about that. You can learn from it in the future, but forget about that in now and focus on the next trade. So kind of maintaining that presence, that present moment attitude is really important in the markets. Also, all soccer players and athletes have their own set routine, and it's really important to have a routine in trading, a set schedule. So you're not thinking about trivial matters. You're focused on each trade and executing everything to as perfect as possible. Yeah, those are just a couple points. And I just definitely think like the overall mindset of being an athlete, persistence, resilience, being able to fail and then bounce back. And then also the glory is nice too when you do nail a great trade, just like winning a championship.
Absolutely, that's great. So Judah and I have a lot of questions that we want to talk to you guys about or ask you guys. So Judah, you want to kick us off?
Yeah, so now that you guys mentioned that you started off with SPACs, I assume that was mainly fundamental. I mean, I remember DraftKings, that was just based off knowledge, and like you know what DraftKings are. You probably used it in the past. It was exciting, and especially just getting into the markets. That was the first thing on my mind, at least when it came to SPACs. Same with Nikola, and we had like huge SPAC moves.
Yeah.
Was that basically just kind of fundamental and research behind it?
Well,
you use technical?
That was part of it. It was also just kind of what we first started. But this funny parallel is we like say that we always had the knowledge of risk management, because part of the reason we like these is because most of them had a net asset value floor at 10. So we were like, wow, if we can get in at around $10, this is an asymmetrical trade. If they announce a merger or a partnership, like you have that defined risk at 10. So that was another reason. And, it was just kind of the first thing that we came across when we got into the game.
Yeah, once we first entered the Twitter, like the FinTwit space, we kind of were in that SPAC area of FinTwit, and people are some detectives in there. So with that SPAC floor, there'd be rumors of Lucid Motors merging with CCIV. Load as much as you can near $10, and you have that asymmetrical leverage. Nikola, I did catch when it was VTIQ. And the funny thing is, like, I was just randomly scrolling social media. Some guy made a video on VTIQ, and I brought it to Connor and to some friends. And back then it was $18. And I mean, guess partly luck, partly timing, but we got out around like $76. So didn't really have sell rules back then either. Just intuitive feel, felt extended, so got out around those highs. So that was a definitely interesting trade for sure.
And then how did you guys find, William O'Neill and Market Wizards and pretty much everyone in that category, Dan Zinger, and decided that's what you want to do? Did you just fall into that, or did you eventually know that you'd want to do something that's more structured rather than shorting small caps or longing small caps? Like, that is a very general area that you guys trade in. And is that something that you guys just ran into?
Well, yeah, it was kind of like once that SPAC edge went away, it was kind of like, okay, wow, like, where do we go from here? We're still new in our careers, but we obviously wanted to progress with it. And kind of just honestly, How to Make Money in Stocks is like one of the most popular trading books. So found that, read that. The style resonated with me, and then kind of took it further. Like Christian Qualm McGee is another, like, his swing trading school had probably the biggest effect on my trading. And then, yeah, like, it just fit with the personality. I also experimented with day trading, all that. And the main conclusion was, you can make the big money is going to be made in the like multi-day, multi-week moves versus trying to catch a couple points each day. And just digging into a company a little bit, finding the themes and trying to ride the winners out made the most sense to me.
Yeah, I think Connor first stumbled across How to Make Money in Stocks. And after SPACs ended, we're kind of just, in a way, in a philosophy shock. Had really no idea. I just realized we had no idea what we were doing. And at that time, I think I was in the middle of, like, my biology classes were ramping up. And I kind of stopped trading. I still paid attention to the markets, did a little bit things here or there. But one summer, I spent the entire summer studying for my dental test. So I pretty much did no trading. And afterwards, started picking up How to Money in Stocks from Connor's recommendation. He actually read it first. And then just the universe of books opened up, from Livermore, Darvis, Minervini, Weinstein, and eventually Qualm McGee as well. Found them more or less recently, maybe in the last year and a half. And he's really, his swing trading course and just his philosophy definitely has revolutionized how I approach trading as well. Definitely took many lessons from him.
So what is your strategies now? Because those guys, I mean, I'm familiar with, many people may not be familiar with, but they all have their own, separate set of rules. And how did you guys pick and choose and time all together? And what exactly is that strategy that you guys went with?
For me, I would describe, like, if I had to describe it in like a couple words, it'd be trend following. But to get a little more detailed, we focus on growth themes and then catalysts. That's primarily what we focus on.
Yeah, I would say like techno fundamental thematic trend following. That's how I would spin it all around. Is, one, want to catch on to the themes, and then two, what's the leading stock in that theme, and then technical wise, what setup is it giving and how can we ride it for as long as we can. And it's not classic fundamentals, right? Like digging into, like a value investor. It's not those type of fundamentals that I focus on. It's more so earnings, what's the story, is there an underlying market theme, and catalyst wise. And usually it all ties together because the best looking charts, the strongest stocks in the market usually have the best fundamentals. NVIDIA is just a perfect example of that. So it goes hand in hand. I'm not going to buy a good fundamental company that has a bad chart because I just don't think that exists.
And do you have any cutoffs to any of the stocks that you guys pick? Is there, market cap cutoff or a price type of cutoff, or it's just anything that hits your scans, you're willing to take?
I'd say I trade anything above a dollar. I don't really venture into the absolute penny stocks. But yeah, that's not too much. Liquidity, like 5 to 10 million, 20 daily dollar volume on average. So just a couple very minimum requirements.
Yeah, about that, but I have found that the sweet spot is a stock with like, a 6-7% ADR that trades, over 50 to $75 million a day. That is what I found to be the sweet spot. Obviously, the smaller stocks can give you those sometimes bigger moves, but the more liquid, high ADR names, less prone to shaking you out and et cetera, stuff like that.
Yeah, and Connor, I wanted to go back to something you were talking about before when you were saying, it's not quite just fundamental driven, but it's like Druckenmiller has a great quote. He says, you have to understand what moves a stock. And that could be its earnings, that could be the sector, that could be a news catalyst, and basically identifying what are the fundamental or the key driving factors of a move, and then using those to keep you on track for a trend. Is that really what you're describing here?
Yeah, 100%.
Yeah, and that can be a difficult process because I feel like in order to master that style or to really implement that style, people need a background in a lot of different disciplines. Whereas people who are just technical analysis, they're gonna be missing some things with the earnings or some of those fundamentals. And if people are just the value investors, they're gonna miss the technical part, or like the event or the news driven catalyst, people will understand something else. So it's a very blended style. And it's interesting because you don't see too many young people who are kind of into that unless they are asset managers. So, when you guys are thinking about a portfolio or anything, you are only on the long side, correct? Or are you looking at long, short, or puts, calls? Do you introduce options at all?
No, only on the long side. And if we do short, it would be via an inverse ETF.
Yeah, exactly.
Gotcha. Yeah, that makes perfect sense from a portfolio perspective, especially if there's rules against, actually, margining
Right.
short or doing something like
Yeah.
that. So excellent. So kind of the process of managing other people's money versus your own, what was that like? And is that part of the reason why you picked the styles of, trading or investing that you currently do? Because it was the most suited for what you're kind of pursuing?
Definitely. I mean, you're not day trading someone's like IRA or someone's in another person's account. It'd just be against the regulators. They would definitely flag that for notice. But yeah, definitely. My style, I like holding as long as possible. Swing traders, you can say, is like between 3 to 5 days, maybe 1 to 2 weeks. But my sweet spot, I kind of like the 3 to 5 weeks to even 2 to 3 months, like catching that move in between quarters, and then maybe holding it to an earnings report if I really fundamentally believe in the stock. And just in terms of managing client money, I definitely think this is a lot more suited than just only using technicals, because clients oftentimes want you to explain why are you in this stock. And if you come out with a blank, it's just not a great look. So we want to understand just a holistic picture of why we choose to enter a stock.
And yeah, to touch on that is just another realization I've had is trading a chart pattern in a vacuum, your win rate's going to be lower, in my opinion, from what I've seen, because, right, any of us can go out and find a good looking chart pattern, but if there's no underlying theme, or there's really no reason for the stock to go up, your win rate goes much lower. So that's that's kind of what had us get into this style. And obviously what Ted mentioned, when you're managing other people's money, you want to get it into a strong name that can trend for as long as it lets you. And obviously technical reasons are always why we sell. That's, when they trigger, it's usually not due to fundamentals, because fundamentals usually always look good at the top and they always look the worst at the bottom.
And what is that stop out, technical wise?
Yeah, so there's combination. There's, I have a decent amount of rules. First is it depends on the nature of the stock, right? And what's the profit. So if I buy a breakout and it runs really hard the first 5 to 10 days, I would sell, depending on the market, it could be a 25% to 50% of the position to lock in the gains and free roll the rest of the position. And after that, some techniques is 21-day moving average is a good reference guide that I use, the 50-day, and then just pure technical signals like highest daily range, gap up reversal, 300% extended from the 200-day moving average. Break it. The 10-week is another one. It's the same thing as the 50-day on the daily. So a combination of technical signals along with just classic trend following moving averages.
Yeah.
How often do you guys use?
Sorry, can you
The
say that
weekly
again?
chart.
Broke up. Oh, the weekly chart.
Yeah. Weekly charts.
Very much. Primarily, so I see weekly levels as the most important. Then I want to see a tight daily chart, and I based pretty much all my decisions on daily and weekly levels, and actually a lot of it on weekly levels. I think they're most in trend following, and especially catching a bigger move on a larger time frame. Weekly levels are a lot more respected than daily levels, and definitely intraday levels.
Yeah, a lot. Because I look at it as it's all fractional at the end of the day. Like you can have a good 5-minute setup that's going to give you like a 15-minute move. If you have a good hourly setup, that could lead to like a 2-3 hour breakout. And then the weekly is just the bigger picture, and clearing a huge weekly base would give me more conviction to put more size on and hold for a bigger move. And there's definitely been some good examples of nice weekly charts that we look for this year as well.
So when it comes to position sizing, risk management, and kind of position management, do you guys have a template that you're kind of roughly using, and then you'll adjust based on your discretion, or like how do you usually think about the size of a position? Is it based on the goals of the specific portfolio, or is it more of a how this opportunity looks on a return basis?
So it's kind of a mixture of all of what you said. For clients, our max position size, no matter how bullish we are, is 12.5% of the portfolio. And then, as you said, we would back up into the risk. So finding a logical technical level, then deciding how much we want to risk on the position based off our discretion of like how bullish we are on the position. Let's say 50 basis points, then that position size is back into the technical stop versus the technical stop plus the risk on total equity. So it's like sliders in a way.
Yeah, and then other factors is is the market behind your back? And then like what Ted mentioned, basically, what do you want to risk on the overall portfolio, and what size can you take, and where's the danger point of when you're buying? Is like, where would you're wrong? Is that 2% lower? Is that 5, 6, 8% lower? And then you figure out the position size.
I guess for the followers, to give a more concrete example to make more sense of it, let's say you want to take a 10% position and your stop is 10%. You're risking 1% on total equity, 5% stop, 50 basis points. So if you want to risk more, then you're going to have to adjust the position size down. If your stop is tighter, then you can have a bigger position size while risking the same amount, if that makes sense.
Yeah, and that stop on day one, the day you take the stock, is that usually static, meaning low of day or a specific level, or is that a level given the daily chart or given other type of factors?
Yeah, it's based off the daily chart and weekly levels. And then let's say you have like a tight pivot on the right side, like a consolidation. We like to put stops around those lows, but maybe a little bit of a buffer. We can't necessarily do low of the day stops because we can't day trade that much for clients.
Right.
Maybe 1 or 2 here or there if we have to, but ideally it's not what we want to do.
Yeah, so I mean, recently anyway, many times you'll see like it clears out low of day before heading higher, and that used to be, I guess, a good strategy and tactic like a year or 2 years ago. But now I've been noticing it a lot more that it usually clears out the low of the day. So like you're either, if that's the strategy you're going to use, you're better off just waiting, at least an hour waiting for some sort of trend to happen first. Waiting till midday at least, or at least a few hours before taking it, because right off open, try to get in like 5 minute, 30-minute chart, you're gonna probably get stopped out and they'll head higher. So
Yeah.
yeah, that hasn't been so great lately. Anyway.
Yeah, that's definitely important that you note that. It definitely paints temperature and texture of the current market, that there's less momentum for sure and less buying appetite. Because if we go over some of our biggest winners, I'm sure you buy it, it clears the level, and it takes off. Like Owen on the breakout on a 5-minute chart is a perfect example of algorithms just accumulating the entire day, never breaks the 5-minute 20 EMA. And you'll see that on the SMCI breakout earlier this year, NVIDIA's breakout. And that's when you really know there's institutions have an appetite to buy stocks at the moment.
And the stocks you take, it doesn't sound like it does this. It sounds like it does it more over time. But if something moved 30, 40, 50% in one day, how would you manage that?
So that's never happened before with the names we trade, because we're unable to trade the small mid caps with like 20, 30% ADRs. But if that were to happen, I mean, we could use a day trade to trim some off. Clients aren't going to be pissed that we taken a partial profit on a 50% winner. So we can,
right, like Chewy, for example, you get those here and there that you may take, and for whatever reason it does that. Not even on the smaller cap names, but for example, like Chewy, I mean, 10 billion market cap, and you get like a 15% intraday move today, which I don't know if that would have hit your criteria anyway. But then you also had that breakout on June 18th, which also moved like 17%, and then I guess within 2 weeks, because of the Kitty tweet, it went to 40 and it pretty much doubled. So that's like something that's like, I guess, rare occasion you would, I guess, change around rules and sell. Or
definitely, yeah. If you have something climactic like that, definitely we'll sell into that. But we're not really selling day one, really. Even like on this Chewy breakout today, we wouldn't sell. We try to hold at least a few days before taking a partial profit.
Sure. And then, so as you're managing positions over time, let's say you've had something for 5 months, 6 months, it's doing well. Will you have to trim to keep the position size to that 12.5%, or are you able to let it become a larger part of a portfolio?
Yeah, you can give or take. It can become larger as the position appreciates, but if it's appreciated that much, we'd likely probably lock some in as well, and then just to a position size where we're fine holding, say it pulls back 15% to the 50-day, like put it to a position size where we'd be fine emotionally with that. But yeah, give or take, if a position really balloons up, that's fine as long as it's acting well.
Yeah, and then do each of you kind of have like an example of like a trade that is just like your A plus, like exactly what you're going for, like that really encapsulates your style? And people usually like this kind of question because it's a nice like highlight reel. But I'm curious to know, the thought process that goes into it. If you have an example, each of you.
Could we go back like in time?
Yeah, 2003. Go back to whatever you want. Yeah.
Okay, yeah. For me, well, NVIDIA and SMCI, but let's talk about SMCI on January 19th, 2024. This setup on a weekly chart is about a 6-month base. You had a prior run of about 300%. You had multiple quarters of triple digits earnings and revenues. You had a catalyst with the AI theme. ChatGPT was just getting started. We knew that GPUs were in high demand, and SMCI was part of that data center warehouse theme. And so you had this super nice digestion for 6 months, got really tight on the right side, and then they pre-released guidance. And so that's a catalyst. You have the fundamentals, triple digits earnings and sales. You have the theme as well. And then you have the weekly chart base, and then a massive breakout on absolute, just huge volume. So that is an example of everything checking my boxes. And yeah, that would be a template model book stock for me.
Yeah, I'll go. I kind of touched on like theme is like one of like the biggest things in my trading. So I would say MicroStrategies February 26 is, I took this one and this just kind of fit all my criteria. It was, first of all, it's like, I like to look at all the stocks in the group, right? So Bitcoin was coming out of a pretty big base, and off the top of my head, you had Coinbase, Mara, Riot, like a basket of like 6 to 8 crypto stocks that were looking like super explosive. And then on that day, MicroStrategies broke out of a cup and handle with volume. And then when you look at the weekly, a big weekly rounding base is one of my favorite setups. And when you clear that like base high with volume, with a clean like daily flag, that's like all green lights to go. And you had the theme. Bitcoin is known to have a ton of momentum, and MSTR was the pick for the group because it had liquidity. It was like at the time, I think it was like a 8 to 12% ADR. So it could make big moves. And yeah, that one trended above the 10-day moving average for like 160%, never breaking the 10-day. And that's like the perfect stock you can get, is like once it breaks out, it just keeps going. And that's why, sometimes I think the edge is more for swing and position trading, because if you have some simple trend following rules, as long as you just ride that average in a strong market, they respect it pretty well.
Yeah. And I just wanted to add, like, the question is nice of us showing our biggest winners, but at least for me, Connor can maybe talk about his. I bat around like 30 to 35, sometimes high into the 40% range. So I still lose more than I win, but it's having that asymmetrical risk to reward, or reward to risk, that creates a positive expectancy. And a lot of new traders, if you are one, you always think about the high win rate. If someone's selling you a high win rate, it's a higher chance that they're a fraud and that they don't know what they're talking about, because the greatest investors, traders from all different time frames, emphasize the reward to risk ratio far more than win rate.
And Chris, you mentioned Stanley Druckenmiller, and like a characteristic of like the best traders is their skew was so big on the winning trades. And like, for one thing, for what I battled with when I first started is over trading. And you don't need to trade every day regardless. If you just waited for the 5-star A+ fat pitches right down the middle, those take care of all the little paper cuts. Of course, no one's perfect. Everyone overtrades at times, like it's a battle every day. But if you really understand your edge and have a set criteria of what you're looking for, I think that helps under trading. And that's obviously something, try to work on every day, is really like going back at your past trades and saying, okay, well, this was one of my best trades. Is the chart I'm going to trade tomorrow, does this look remotely close? Are the characteristics similar? And if not, then, maybe it's not a 5-star setup.
How many stocks do you guys usually have in your portfolio at one time?
Between 8 to 12.
8 to 12, yeah.
Because you'll have some partial positions, some just trailer positions as well.
Right.
So it's not too strict. It's like you have to have 10. You're going to kick one out to add another one.
And do you guys ever, I know you guys work together, correct?
Yep.
Separate portfolios?
Yep.
And also we have our own separate clients, and then we actually manage a piece together of the bigger portfolio at our firm.
So how do you guys collaborate together? What do you guys usually agree on? What do you bring to each other's table? And then do you guys ever usually agree on something and either you take it anyway, or do you just, say, you're right and move on from that idea?
We agree most of the time, to be honest. If we don't agree, then, and if I don't like his trade, but he's like, hey, like, I really like this one, then he can take it anyways.
Yeah, pretty much the same as well. That's kind of how.
But similar styles, so usually we will agree on it, but not all the time. Like
bigger picture philosophy wise, we pretty much align on from A to Z. It's just maybe a couple entry tactics here or there that might differ.
We also wanted to get your thoughts on current market conditions. Right now, we're in August of 2024, and we've had a really nice run since November, and now we're just November of 2023, and now we're just starting to consolidate a little bit up here, and we wanted to just get your thoughts on how setups are looking now versus how they looked kind of along the way. I know we've had something similar back in April and May 2024, and between then and now, and before that from November, it's just been kind of trending up. But now we're kind of getting that little pullback correction, and now we're pretty much back near the highs. Today was a little bit of a pullback, but generally bigger picture.
Yeah.
What
So bigger picture, I see NVIDIA is down a little bit after hours. I know this is, the most important event of our lifetimes, but talking about semiconductors, besides NVIDIA, that's not one sector that I really like right now. I mentioned group, and if I look at the whole group, I don't think Micron looks good. I don't think Qualcomm looks good. Avgo looks all right. NVIDIA is really the best looking one, and it's down on earnings. And I think we had that carry trade fears, VIX hit 65. Volatility was quite big for a couple of days, but off that low, small caps and more rate sensitive sectors have outperformed. So that's an area that I'm more focused on. Some of these stocks are front running the rate cut, but you have Rocket Mortgage that's trading at highs, United Mortgage, those two have been strong. And then, some of these lending companies, Upstart had an earnings gap, which is, to talk about setups wise, Upstart was a fantastic setup, traded it myself actually, but on that earnings gapped up on huge volume. It was like a double-digit earnings surprise. Earnings weren't great, but when you have a stock that's neglected for so long, gaps up on volume on out of a range, that's trended nicely. So that one, and I do see Affirms up after hours. So more so I'm more focused on the rate-sensitive sectors. I don't think the AI trade is necessarily over, but some of the best leading stocks of this run are entering stage 4 declines. Abercrombie and Fitch, SMCI's broken, ELF. Those were 3 of the model book stocks. They're breaking down. Microsoft, Google, they're clearly showing relative weakness. Meta and Netflix look good for big tech, but sum it together, biotech's one of my favorite sectors right now with the application of AI. Technical setup looks really good. Regional banks is another area of the market that I like. So I have been shifting my focus to, more small cap focused, growthier areas of the market. And Ted mentioned ON, some of these newer merchandise stocks that aren't so tech focused because just a lot of distribution occurred in these tech names and charts are just super messy. And for me, a V-shaped recovery is pretty tough to trade and definitely not my style.
Yeah, Connor did a really good job kind of summarizing our thoughts on the market. One thing I want to add though is from what we've learned, the average market leader, so let's talk about NVIDIA, runs about 18 months, 4 to 6 quarters of beat and raise, and we just got the 5th one, arguably the 6th one. And definitely this is a 3rd or even a 4th stage base. And if you look at a log weekly chart, and I emphasize log charts because to me a $10 to $20 move is 100%, $100, $200 move is 100%, $500 move, $1,000 move is also 100% move. So I want to see my weekly charts reflect that. And if you look at a weekly chart, this recent base is definitely a lot wider, sloppier, and looser. And that's definitely a signal that more institutions are distributing NVIDIA into the market, less are buying up the stock versus prior quarters. And we know Druckenmiller offloaded a lot of NVIDIA, Tepper, I think, as well.
Yeah.
So we've seen a lot of funds offload NVIDIA as it reaches pretty rich valuations. Even though people talk about the forward PE and the current PE, oftentimes that's because the stock grew into the once previous high PE ratio. And a lot of times stocks will top at a reasonable PE. And this is where a lot of amateurs fall into the quote unquote cheap trap. And once a stock tops, price declines, right? So PE actually declines as well. And people buy into that thinking it's cheap. It's like, I missed this whole run. It's declining now. PE is so much cheaper than before. And They start averaging into it, and then boom, you get this new earnings quarter, and earnings misses, and then that PE quickly spikes up again. And that's like a thing a lot of people don't understand with these earnings growth cycles. So that's just one thing I wanted to add to Connor's point. But like he said, previous leaders like SMCI is down 70%, about 70%, completely gave up its whole move. ANF, ELF, Crowd, CDNS, many of these other names, these ones tech and retail consumer leaders are definitely distributing into downtrends.
And then one thing I wanted to mention is, kind of the technique so when the market starts to decline, the NASDAQ's trading below the 10 and 21. That's kind of my basic trend gauge. Got that from Call McGee, and, it prompted me to do a bigger deep dive and say, like, if you really look at it, all your best winners are very likely going to occur when the NASDAQ's trending. But one thing about spotting relative strength is why I got interested in some of these mortgage stocks, and is because as the NASDAQ was declining, you had Rocket Mortgage trading at 52-week highs, LC, that was another one, Tree Lending Club. That was another one that was at 52-week highs. United Mortgage was another one that was right at highs. So the market was screaming in your face that these stocks are beach balls underwater. So if the market starts to, bounce back a little bit, these should be coiled to the upside, which they did. And you obviously had like NVIDIA 20-30% rip off the lows, but I've never seen V-shaped recoveries that fierce and super well. So I was more focused on stocks that were consolidating versus going down, because all the tech stocks came down just as sharp with the NASDAQ. So that was just kind of like how I view relative strength. And especially when the market's declining, that's like the best time. Like the stocks are going to tell you if they're good or bad.
Yep. And then quickly, in terms of some macroeconomics, this whole, like, the 2022 bear market pretty much started because of inflation. So the Fed had to go into one of the quickest hiking cycle of all time. And that definitely led to lower asset prices. But as we started getting more confidence that inflation was coming down, so seeing some disinflationary numbers in PCE and CPI and PPI, the market started discounting many rate cuts. So coming into this year, I think it was like 6 to 7 rate cuts that we were discounting. By June, it was almost zero. And more recently, with some disinflationary numbers and weaker labor market data, we're starting to price in 2 to 3 rate cuts by the end of the year. And some analysts say that this is the most anticipated rate cut of like all time, or at least in a long time. And so one possible scenario is a potential sell the news event in this next September FOMC. So that's a potential scenario I'm weighing in my head as well. But anything can really happen with those. We have PCE this Friday, so that's another important gauge that the Fed looks at as well.
Yeah, that's fascinating, and it's great to see that you are taking in macroeconomic, data, the micro stuff, basically everything, because in markets it all matters. Unless someone has a very niche kind of strategy, the more that you can kind of at least get a gauge of what's going on, the better. And then you both made a great point about cycles, and how as a cycle goes on, the stocks look cheaper, they grow into their PEs, and then by the time they finally have that beautiful earnings quarter or something like that, but that's kind of the peak, then it catches a lot of people off guard. And I think a sector that really exemplifies this is the commodity sector, and where you get those big value traps, where if you have something like the price of copper or silver or something, if the commodity price went up 100%, then over the next year, all the mining companies and everything, their margins all expand, the PEs go lower, and right towards the top, they look the cheapest, and then people average in. But it's about the future. It's not about the present. So that was a great point.
I learned this concept from Mark Minervini, actually, and he calls it the inverse cyclical cycle. So for a lot of times, cyclicals, they bottom on the worst news, the highest PE, worst earnings and revenues picture. And like you just said, the earnings comes in, revenues, margins expand, all the news is positive, and then that's when they top. So cyclicals love to do that, or they follow that trend and cycle.
Absolutely. So we want to touch on kind of the situational awareness of the market. So if market conditions were to, go back to more of like a 2022 kind of style where things are very choppy, more bear market style, would you adjust your portfolio strategy at all? Would you just focus on relative strength? Would you be fine sitting in cash? How would you approach something like that?
Right. So we'd definitely be fine sitting in cash. It's nice that money markets yield 4 to 5% right now. So we'll put a big chunk of cash in there. If we do head into like a 2022 bear market, we are open to using, like Connor said before, inverse ETFs for just smaller tactical shorts here or there. But we don't want to, like as a primary long only shop, we don't want to lose the forest for the trees. So we are more so monitoring relative strength and seeing this, like the potential leaders that may set up in the future. Just because they're showing relative strength, that doesn't mean we plunge in. We're just tracking those stocks for when the market sees an accumulation day, follow through day, in the William O'Neill system, to start re-engaging in the markets. And then, like Connor said, the NASDAQ or S&P 10 and 20 is a great gauge for us in terms of situational awareness. And just even a simple, what has your last 5 to 20 trades have done? Are they on balance winners, losers? Are they holding up, breaking down, following through, looking at your watch list, your previous focus lists? And from all of that combined, as well as even some other breadth indicators we use, that's kind of how we gauge the current market environment.
Yeah, just to touch on that is, yeah, if the market, stay cash, be nimble, but I also think there's usually some sector, some group of stocks working all the time. Earlier this year, when the NASDAQ pulled back, I forget what month it was, but, tech stocks weren't working, but simultaneously you had FCX, SCCO, two big copper names breaking out of picture perfect bases. So I always try to skate to the puck. So, if tech's not working, what can I find that's going to work? And, it doesn't always work that way, but, and even, 2 years ago, the big group move in oil when the market was pulling back, that was a huge tell. So just, trying to find the relative strength and tradable opportunities, sitting in cash and or using inverse ETFs to, catch some shorts.
Yep.
Excellent. So for the next part of the interview or the podcast, Judah, do you want to kick us off for some of the fun questions? And we usually start with like crazy stories, but I'll let Judah pick which one he wants to go with out of that list first.
Yeah, so you guys mentioned what you used to do before trading, and we wanted to know what you guys like to do outside of trading now. Is that the same thing? Did you guys just, are you guys still doing that? Or did you guys start to do different things now that you trade? What do you guys like to do outside of trading?
Hobbies are pretty much the same. Like now that I graduated, I still play in like a, fun pickup soccer league. So, I do that. I'm a huge golfer, so I like to golf as much as I can. I live in Fort Lauderdale, Florida, so I love the beach, going for runs, traveling, trying new restaurants, kind of pretty basic, but yeah.
Yeah. Also live here in Fort Lauderdale. Actually, we live in the same apartment. So the beach is a big place we go to, trying out new restaurants, new food. I like working out almost every day. Just have Sundays as a rest day. I spend a lot of time at the beach on a Sunday. Reading, watching podcasts. The joke at our firm is that I'm like addicted to podcasts. And that's one of my favorite, honestly, leisure times to watch podcasts.
And then even then, like, I feel like I still spend a lot of my free time when the markets close, researching, doing other things. Still love the game, and it never feels like work. So I always kind of reading up on something on Twitter or doing something related to the markets as well.
Right.
Definitely. And so here's one that's not on the list, but I'll throw it in. If each of you both had $1 billion just kind of handed to you, which of your either, mentors or like these are more like the Druckenmiller types, like the big names that you've learned from, who would you hand that pile to for the next, 15 years?
I gotta think about that for a moment. Druckenmiller would definitely be up there. Didn't really talk about my value investor idols, but Bill Ackman, I'm a huge fan of as well. even though I don't really emulate his strategy either.
Yeah, I would have to go Drunken Miller as well.
Yeah, hard to go wrong with that.
Yeah.
The guy's a beast.
Yeah. And then crazy stories over the years. I mean, I know that you guys are, still within the first, decade of your careers and everything in finance, but have you come across anything, wild so far? Or, what comes to mind with crazy stories?
Okay,
Honestly,
so I got one, Connor. So super early on in our career. So it was me, Connor, and a different friend from our boarding school at Shattuck, who we also played soccer with. And that's kind of how we got started trading. And towards the end of the SPAC craze, and throughout, we traded warrants too, and those provide even bigger returns. And there was this SPAC SCPE, and we're pretty bullish. Connor knows what I'm talking about.
Yeah.
We're pretty bullish the medical technology. I think it was some sort of glucose monitor.
yeah, it was Mentech.
Yeah, and there were some rumors that Apple might buy them out. So we loaded up on the warrants, and our biggest lesson is liquidity is so important. All three of us were loaded in those warrants, and they were the most illiquid things of all time. So we had to like almost trip over each other to slowly scale out those warrants. And what's funny is once we all got out, those warrants tripled and quadrupled like a month or two later.
Yeah, they call those Hotel California trades where you can check out anytime you like, but you can never leave.
Yeah.
I would say, honestly, trading wise was the regional banks collapsing, because it was funny because like 2 weeks before, I was talking to a colleague and I was like, man, like something's going on with all these banks. Like the charts look broken. Like I have no idea what it is, but like FAZ was the short financials ETF. It was like setting up, and I was like, like something must be going on. And then obviously, the whole thing when, all of them started collapsing, it was a pretty crazy event to experience. And like when I'm trading all day, every day, like to see my first real event like that was kind of crazy.
Yeah, it's wild what can actually take place, because a lot of times I think with traders or investors, it's like you're so used to using like a normal template when usually markets are working correctly, but there are these periods where things can just get so out of whack. And Buffett brings this up, and he says, the market doesn't have to open tomorrow. And there are times when you could either have crazy events happening or system outages, and you could have the market closed for weeks or a month at a time.
Mm-hmm.
And I feel like that's just something that's not even on the bell curve of risks that people talk about, and especially on the option side where people are locked into something and the market's closed. But I think that the regional banks were a perfect example of that, because I know people who had insanely massive trades with puts on some of those regional banks, and they were halted past the expiration, and they were so there's a whole set of risks when times get crazy like that. So but those are great stories. Well, that's everything that we had on the agenda for today. So I really appreciate you guys, coming on and sharing your time, your stories, and your talents. So where can people go to learn more about you and to follow you?
So you can follow us both on Twitter. Mine's Ted H Zhang, and then Connor, you can give yours.
Yeah, you can DM me on Twitter, Connor J Bates _, and then obviously email Connor@revereasset.com is probably the best. Both of those are the best ways to reach me.
And then Ted@revereasset.com, and then our YouTube channel, you can just search up revereasset.com. You'll find our weekend videos and our daily videos there as well.
Awesome, guys. Well, thank you. We really appreciate you coming on, and we'll stay in touch.
This was fun. Thank you.
Enjoyed it.
Thank you for tuning in to this latest episode of Trading Takes. Don't forget to hit the like and the subscribe button. And if you enjoyed this conversation, please check out some of others with some great traders. Thank you for watching.